Hello everyone and welcome to UBS Trending. I'm Andrew Lee. So today is the second day of our Sustainable Investing Focus Week, an immersive educational experience designed to help you discover how sustainable investing can advance your financial goals. I'm pleased to be joined today by my colleagues Jason Draho and Dan Scanzaroli as we discuss sustainable investing in a portfolio context. Guys, welcome.
Great to be here.
Thanks, man.
So Jason, let me start with you. It's long been our view that sustainability is relevant to all investors. And increasingly, we're hearing from clients that they want to bring their sustainability objectives into their investment portfolios while still delivering on financial return expectations. So, if we start with asset allocation, all of our advice starts with asset allocation. Can you walk us through how you take sustainability considerations and really use them to create a set of asset allocations that are intentional and focus on sustainability?
So there's multiple considerations we think of when we want to create an asset allocation, a strategic asset allocation for sort of a long-term portfolio. Incorporating sustainability. You mentioned intentionality. So I think one of the first things we'll think about is the intentionality. We're trying to accomplish certain things with sustainable investing. So we want to think through the allocation such that are they achieving certain goals or objectives from a thematic perspective, from an engagement perspective, impact perspective, as opposed to a more conventional asset allocation, which has allocations to, say, large cap equities, small cap, things of that sort. So we want to pivot away from that mentality to something thinking about are these investments going to achieve certain desired things in terms of the intention that we want? So that's the first consideration. A second consideration is diversification. So a lot of way people are thinking about sustainable investing right now is like ESG scores. You want to invest in companies that score high ESG scores. That's a criteria that we would consider. But we also want to think about impact investing. Are we investing in strategies where people can directly impact the outcome of the company investment? Thematic investing. Are there ways in which we think for electric vehicles, for clean water, things of that sort? So you want to go beyond just the conventional sort of ESG scoring to think more diversification from a sustainable perspective. The third consideration is sort of blending both sustainable components and also financial performance. So ultimately, people still want to make sure their portfolio is performing in line with a conventional portfolio. So as we think about it, we understand the attributes of these different investments. So we get the sustainable criteria that we've talked about, but also does it deliver the financial performance? Because ultimately, people don't necessarily want to sacrifice the financial performance to achieve their sustainable goals. And we don't think they actually have to if you construct the portfolio correctly. So we certainly weigh both of those to get the same kind of outcome. And the fourth criteria is to think about sort of almost like pushing the frontier. We know the set of solutions out there. We know what people are doing. From the get-go, from a few years ago when we first started this effort, we wanted to sort of push the envelope. So the approach we took was definitely unconventional. I think people were kind of scratched their heads a little bit. Now I think more and more the industry is coming around to us. They're also then creating solutions and opportunities that sort of align with the way we've been thinking. So helping sort of push the frontier. I think that was the final thing that we did, which made it a little more challenging, but it's also in some way kind of ultimately more impactful for what we've done as well.
Yeah. Makes a lot of sense. So let's take it from the framework to kind of what we're seeing in the market today. So maybe you can talk a little bit about the house view, what we're seeing in the markets today, how we're positioned today, and really how should investors think about sustainable investing in the near term. What are we're managing through market volatility. How do they think about sustainability in that context?
So in terms of say a sustainable portfolio versus a more conventional house view portfolio, the same thought process of how do you want to make tactical adjustments, kind of incorporates both. So you start with what is your overall view in the markets? And clearly we've had a difficult start to the year. I think that goes without saying. We're in an environment where the Fed is trying to tighten financial conditions to cool the economy because inflation is high, the labor market's high. So under that environment, you think, well, how do you want to allocate and adjust your kind of portfolio tactically? So in this case, we've been sort of taking the view that we don't want to deviate far from our overall strategic benchmark, and that applies to both sustainable and non-sustainable portfolios. We think about also then, given how high the rates have moved, where, let's say, within the fixed income space, do you want to be kind of allocated? So something we sort of evolved recently is, moving away from taking credit risk to a little bit more interest rate risk or kind of moving up in quality. Again, that applies to a conventional portfolio, but we can understand in the fixed income portion of a sustainable portfolio, where are your exposures, where's their kind of consequences. On the equity side, one of the things we're thinking about is, we probably have a world where we have high inflation for a longer period of time. Part of that due is sort of temporary, hopefully temporary, factors related to the pandemic. But one of the drivers, for example, that could keep inflation high for a long period of time is the transition, the energy transition, as we go from fossil fuel based to kind of clean energy. On top of that, you have the complications like with the Ukraine war. So given that sort of macro environment, how do we sort of adjust the equity portfolio? We don't want to get sort of too cute in sort of making those adjustments, but we think about where can you sort of capture value. In some conventional portfolio, you might have traditional energy companies, But a sustainable portfolio, they can also look at that and they have that sort of sustainable lens to think about which companies are best positioned sort of going forward, which ones are trying to make that transition. So you still get that sort of exposure, knowing these are companies that ultimately will benefit probably from higher energy prices, and that's a driver of inflation, but you sort of capture it in different ways. So I think the broad thing is, in a world of higher inflation, there's different ways you can position for it. The way we do in a sustainable portfolio is the same kind of ideas, trying to take advantage of that as we do in a conventional portfolio. And then those sort of positions and adjustments to reflect the allocations, but also hopefully the implementation as well.
Yeah, that's great. It makes a lot of sense. So, Dan, let me bring you in here. We talked a little bit about asset allocation. What are some of the other things that investors need to think about when they think about bringing sustainability into portfolios?
Well, as with any other portfolio construction, the first essential step in deciding your asset allocation is making sure that it aligns with your preferences, your goals, and your objectives over the course of your lifetime. And when we think about forming a robust financial plan, we recommend that you start by thinking about segmenting your wealth between three strategies: liquidity, longevity, and legacy. Many people very immediately jump to seeing how sustainable investing can fit into their legacy strategy, the strategy for the impact that you want to leave behind on the world, with those assets being bequeathed to other individuals after you're gone. And that does make a lot of sense. That allocation doesn't have obviously income needs, because it is for the benefit of others and for the benefit of the impact that you want to have behind. And so, looking at, for instance, impact investing, it does fit very nicely into that strategy, because we see that there are private equity investments where the management company can get a seat on the board to influence that particular company to develop more sustainably. But that isn't the end of the story. We need to look at the full opportunity set. As Jason had pointed out, we're not limited to just alternative investments, but we can go across bonds, we can go across equities, and because of that, we actually see an opportunity and a necessity to align your preferences across your entire lifetime with both liquidity and longevity, so that you can start that impact now. And so, as an example of that, when we look to the liquidity strategy, which is meant to spend, for your spending needs over the next 3 to 5 years, we can look to use short-term bonds that are issued, let's say, by the World Bank, that have a focus on developing, social and physical infrastructure in developing countries. As we think about, positioning ourselves for our long-term retirement and the goals we have for our retirement in the longevity strategy, we can grow those assets by reorienting our equities, for instance, towards companies that operationally have put a focus on leadership and diversity. Altogether, this means that each stage of your financial plan not only can keep you on track for achieving your financial goals, but also reflect those preferences and have the impact that you're looking to have on the world.
Yeah, that's great. Maybe let's dig into one of the strategies within the Wealthway framework, whether it's longevity or otherwise. How do we think about, or how should investors really think about constructing diversified asset allocations or portfolios when keeping sustainability in mind? Or what are some of the questions that investors should really ask when they're doing so?
Yeah, as with constructing any portfolio, even when we look at SI, the main focus, as Jason also pointed out, is to focus on diversity and a strong, robust risk management approach. The types of strategies that you're looking for in sustainable investing, just when you look to any other types of style investing, they come with natural biases that we're actually trying to capture. But those biases can also disrupt our ability to keep up with, let's say, traditional benchmarks. And so, as we think about, sustainable investing, those questions you should be asking yourself is what are those biases for the areas the themes that you want to have investing sustainably? What are they in terms of how much of a deviation they are from a sector, in terms of the concentrations they have in particular regions, and even looking at factors like value and growth. Many of these companies, when we focus on sustainable investment, many of them will have a tilt towards technology in terms of smart grids or in terms of electric vehicles. That also comes with a growth bias, and we don't want to be overly exposed to those sector biases or those different factors. We want to think about how it's essential from a portfolio level to reflect those different preferences, but also combine it with complementary, SI strategies and themes like water and diversity and all those other areas that actually are going to access the market in a different way, where we can manage the overall overweights and underweights relative to a traditional benchmark, understand those sector biases, but make sure that they're complementing each other. That key diversification is going to smooth the ride, it's going to lower the tracking error, it's going to make sure that we have a similar risk and return profile as the objective of how you want to grow your wealth relative to your preferences. And it also allows us to obviously, manage the underperformance risks, but also gives you the opportunity to outperform within the framework of a sustainable investing portfolio.
Which is exactly what we want to achieve in the end, right?
Exactly.
Awesome. Thanks for those perspectives. So Dan, Jason, thanks again for joining me today. Clearly, there's a lot more that we have to discuss on this topic, but ultimately, the key takeaway is really thinking about it in a diversified portfolio context. How do we take sustainability issues into consideration when we think about diversified portfolios, both thinking about long-term financial and the societal returns? So for more information and access to UBS content, visit ubs.com/views. Follow UBS on social media, whether it's LinkedIn, Facebook, Instagram, and Twitter, and check out past UBS Trending episodes on demand on our website. And as always, if you have any questions, please speak with a financial advisor about your portfolio. Until next time, I'm Andrew Lee. Have a great day, and remember to keep your eyes on what's trending.